So when Ethos Technologies first launched, it actually took them 54 months to hit their first major milestone.
Right, that's 4.5 years.
Exactly. 4.5 years of, grinding out code, building carrier relationships, acquiring those early customers just to protect their first 100,000 families.
It's a long grind.
It really is. But in the second quarter of 2026, they just hit that exact same milestone.
The 100,000 policies.
Right, 100,000 new policies, but they did it in 90 days.
Oh, wow. Yeah, I mean, that's the defining moment, right? Where a linear growth trajectory officially, goes exponential.
Completely.
You spend years building this machine, and then suddenly the machine just starts building itself.
And that compression of time, that is the hook for today's deep dive. We are looking at the Q2 2026 earnings call for Ethos Technologies.
Ticker symbol LIFE.
Yep, ticker LIFE. And, if you're a retail investor holding this stock, or even if you're just looking at the tech and financial sectors, wondering where the actual disruption is happening right now.
This is the data you need.
Exactly. Because we are cutting through all the corporate phrasing, all the Wall Street jargon. The mission for this Talk Tickers edition of the Deep Dive is simple.
We want to be data forward.
Right. Data forward, plain language, highly opinionated, and most importantly, actionable.
Because you don't want the fluff. You want to know what this actually means.
Exactly. We are looking at the actual transcript to give you the story behind the numbers and ultimately the bottom line on what this means for your portfolio.
And what makes this specific quarter so compelling is that we are really watching a company operate right at the intersection of two entirely different economic models.
Okay, let's unpack this. What do you mean by two different models?
Well, on one side, you have the legacy life insurance industry, right?
Yeah, right.
Which is, notoriously slow.
Yeah.
It's heavily regulated. It's entirely paper-based for the most part.
Super old school.
Exactly. And then on the other side, you have hyper-scalable consumer technology.
Like software as a service type stuff.
Yeah, exactly. And usually when tech tries to disrupt a legacy financial sector like this, the tech company just bleeds cash for a decade.
Oh, totally. Just burning VC money.
Right. Trying to acquire customers at any cost.
Yeah.
But Ethos is doing something completely different here. And honestly, the financials from this quarter prove it.
Yeah, they really do. So let's get those top and bottom lines on the board right now because the numbers are, they're aggressive.
Very.
Total revenue for Q2 came in at $189.6 million.
Wow.
Right. That is a 113% year-over-year growth rate.
So they more than doubled it.
They more than doubled their revenue compared to the exact same quarter last year.
But, revenue growth in a vacuum, it doesn't mean much if you're spending $2 just to make one.
Exactly. Which is why the metric that really stands out here is net income. It was $19.5 million.
Which is a 10% net margin.
Yep. And on an adjusted EBITDA basis, they brought in $35.2 million.
So a 19% margin there.
Right. And as we mentioned right at the top of the deep dive, they activated over 107,000 new policies in this single quarter.
Pushing their cumulative total well past 700,000.
Which is just staggering. But when you put those growth and profitability metrics side by side, it really forces a reevaluation of how this company should even be valued, right?
What's fascinating here is that in the software and technology investing world, there is this benchmark called the Rule of 40.
Right, the Rule of 40.
Yeah, it's a very simple heuristic. Investors use it to determine the health of a software as a service company or really any hyper-growth tech company.
So how does the math work for that?
You literally just take the revenue growth rate, the percentage, and you add the profit margin percentage to it.
Okay, so if you are growing revenue at, say, 30% year over year, and your profit margin is 10%, your score is 40.
Exactly. You hit the benchmark.
And investors generally consider that to be a premium, highly attractive business, right?
Right, because it proves management is successfully balancing the cost of expansion with actual, bottom line returns.
Like it's the restaurant analogy. If a restaurant manages to double its customers, so 100% growth rate, but they somehow keep their kitchen costs incredibly low to maintain a 20% profit margin.
They have a score of 120.
Exactly. Or, if you are growing at 50% but losing 10%, you are still at 40.
Right. In that case, you are burning cash, but the growth is so fast that it justifies it.
But the problem with the Rule of 40 in today's market
is that very few public tech companies are actually hitting it.
Really?
Yeah. I mean, at least not without aggressively manipulating their non-GAAP adjusted
Yeah.
earnings,
Oh, like excluding massive amounts of stock-based compensation to make the margins look better?
Exactly. But let's look at Ethos. They have 113% top-line revenue growth.
Okay.
Even if we use their more conservative adjusted EBITDA margin of 19%, you add those two numbers together.
113 plus 19.
They aren't hitting 40%. They're hitting a score of 132%.
That is, they are blowing the doors off the benchmark.
They really are.
But, the scale of that outperformance, it's actually what makes me want to pause and push back a little bit.
Okay, play devil's advocate.
Right, because we see companies post triple-digit revenue growth. It happens.
Sure, yeah.
But usually it requires a massive subsidy, right? Like a ride-sharing company artificially lowering the cost of a ride to steal market share from taxis.
And funding the difference with venture capital.
Exactly. Or a food delivery app offering endless free delivery promos. They are buying the growth.
Right.
But Ethos is doubling their revenue while posting almost $20 million in true GAAP net income.
They aren't subsidizing the customer experience.
No, they are extracting real profit from it. But life insurance is arguably one of the most complex, risk-heavy financial products you can sell.
It definitely is.
So how are they processing 107,000 policies in 90 days without taking on just a catastrophic amount of unpriced mortality risk?
Well, that is the structural mode of the business. You cannot achieve 113% growth in insurance using human underwriters.
It's impossible.
The legacy system simply breaks. If a traditional insurance carrier suddenly got 100,000 applications in 3 months,
they'd panic.
They would have a backlog stretching into the next decade.
Because the traditional process is so clunky. It involves a consumer filling out a massive paper application.
Right, a broker submitting it.
And then a paramedical examiner actually physically going to the applicant's house to draw blood and collect a urine sample.
Yeah, and then taking those physical samples, mailing them to a lab, waiting for the results.
And then faxing those results, literally faxing them to an underwriter.
Who might also request an attending physician statement from your primary care doctor.
It's a process that takes weeks, if not months.
Exactly. The human underwriter manually reviews the files, they look at the lab results, check the actuarial tables, and then make a subjective pricing decision.
It's so slow.
It is slow, it is expensive, and the marginal cost of processing the next application is basically identical to the cost of processing the first one.
Right, because you have to pay the examiner, the lab, and the underwriter every single time.
But Ethos Management noted on this call that they are operating with a 95% instant decisioning rate.
Okay, wait, so 95% of the people who apply are getting an underwriting decision and a bindable price right there on the screen.
In real time.
Without talking to a human or taking a medical exam.
Yep. That speed is entirely driven by their proprietary digital underwriting engine.
Which is wild.
The CEO, Peter Colis, actually spent a significant amount of time on the call breaking down what is actually happening in those milliseconds.
Like between when a user clicks submit and when they get a price?
Exactly. The system is pinging external APIs to access massive data sets.
What kind of data sets?
We're talking pharmaceutical prescription histories, motor vehicle records, medical claims billing data, clinical lab histories.
Wow. He mentioned that the algorithm applies over 1 million logic rules per application.
1 million.
Let's think about the density of that. A human underwriter might look at your cholesterol, your BMI, maybe whether you smoke.
Right. Applying maybe a few dozen internal rules to figure out your risk class.
But the Ethos software is running 1 million if-then scenarios instantly.
Right. Like, if the applicant had a prescription for a specific beta blocker filled 3 years ago,
but their motor vehicle record shows 0 infractions,
and their medical billing history shows consistent preventative care,
then what is the precise actuarial risk down to the basis point? It figures that out instantly.
And it does this using over 800 adaptive questions, too.
Oh, the questionnaire changes while you take it.
Yeah, it dynamically changes based on the data it is retrieving. So if the API flags a history of asthma medication, the next question adapts on the fly to ask about hospitalization frequency.
That's incredible.
The technology completely replaces the human underwriter, the blood test, and the waiting period.
And this is why their 19% adjusted EBITDA margins are sustainable, right?
Yeah.
Because their system scales infinitely.
The server cost to process 107,000 applications is a rounding error compared to the cost of employing an army of human underwriters.
Totally. Which brings up an interesting dynamic in their revenue breakdown.
Yeah, let's look at that.
When you look at how they are actually distributing these policies, they have 2 main channels. First, you have the direct channel.
Right.
This is the consumer seeing an ad on Instagram or Google, going to the Ethos website, applying, and buying a policy entirely on their own.
And direct channel revenue was $116.5 million.
Which is up 131% year over year.
Huge growth.
But then you have the third-party channel. This is where independent life insurance agents use the Ethos platform to sell policies to their clients.
And that channel brought in $73.1 million, up 90% year over year.
So both channels are just exploding.
Yeah. And that dual channel acceleration is a massive signal for investors.
How so?
Well, it tells you that the user interface is intuitive enough for a retail consumer to navigate on their smartphone while, like, waiting in line for coffee.
Right.
But the underlying product suite is robust enough that professional, licensed insurance brokers are choosing to use Ethos instead of the legacy carriers they've partnered with for decades.
And to fuel that third-party agent channel, Ethos actually announced a significant product expansion on this call.
The new IUL.
Yep, they launched a new accumulation IUL product specifically designed for juveniles, backed by a partnership with North American Stamens.
I think we really need to break down what an IUL actually is.
Oh, absolutely, because the acronym gets thrown around in the industry constantly. But for a retail investor listening, the mechanics of the product dictate why it's such a revenue driver.
Right. So an IUL stands for Indexed Universal Life.
Okay.
It is a form of permanent life insurance. Now, unlike term life insurance, which only covers you for a specific period, say 10 or 20 years.
And then it just expires worth nothing if you don't die during that term.
Exactly. Permanent life insurance covers you for your entire life as long as you pay the premiums. But the crucial differentiator of an IUL is the cash value component.
Right, because a portion of the premium you pay goes toward the actual cost of the insurance, the death benefit, and the rest goes into a cash value account.
And in an index universal life policy, the growth of that cash value is tied to the performance of a stock market index, most commonly the S&P 500.
But there are specific guardrails, right?
Yeah, usually there's a cap on the upside. So maybe your cash value can only grow a maximum of 8 or 9% in a given year, even if the S&P goes up 15%.
But the trade-off is that there is a floor, usually 0%.
Right. So if the stock market crashes by 20%, your cash value doesn't lose a single dime due to market performance.
It just locks in the previous gains.
Exactly.
It's a really attractive financial vehicle because that cash value grows tax-deferred, and you can actually borrow against it tax-free later in life.
Which is why, by introducing an IUL product for juveniles, meaning parents or grandparents can buy this for a child, they are offering a product that locks in the child's insurability while they are perfectly healthy.
And it gives that cash value decades of compound tax-advantaged growth.
Management noted that their third-party agents have been aggressively asking for this specific product.
And it makes perfect sense from the agent's perspective. It gives them a high-value financial planning tool to offer families, which expands their own earning potential.
And for Ethos, it broadens their product portfolio from just simple term life to complex permanent wealth building vehicles.
All running on that exact same instant decisioning algorithm.
Exactly.
Here's where it gets really interesting, though. Looking at this product mix leads directly to a metric that on its face seems deeply concerning.
Oh, the ARPU drop.
Yeah. We're sitting here celebrating 113% revenue growth, but the average revenue per policy, the ARPU, actually dropped.
It fell by 8% year over year.
Down to $1,758 per policy. So let's look at this critically. If the average revenue per user is dropping by 8%, isn't that inherently a red flag?
You'd think so, right?
I mean, if a company has to settle for lower revenue per customer to drive top-line growth, that usually points to pricing pressure, increased competition, or just a degraded customer base. Why should an investor not view an 8% drop in ARPU as a sign that the core business is diluting its value?
Well, if you are looking at a traditional SaaS company where there's only one product tier, a dropping ARPU is absolutely a thesis-breaking red flag.
It means you are discounting to save churn.
Exactly. But Ethos is an insurance marketplace. The CFO, Chris Capote, actually took this head on during the call, and the explanation lies in a concept called mix shift.
Okay, explain how the mix shift works in this specific context.
So a mix shift occurs when the proportion of different products being sold changes relative to one another. Eco sells term life, they sell whole life, they now sell IULs.
And each of these products has a totally different revenue profile.
Right. What the CFO explained is that the massive 90% growth in their third-party agent channel is being heavily driven by sales of whole life insurance policies.
Okay.
And in this specific demographic and market segment, whole life policies tend to generate a lower initial revenue dollar amount for Ethos compared to, say, a massive multi-million-dollar term life policy.
Right. Because the agents are selling such a high volume of these smaller whole life policies, it literally drags the mathematical average down across the entire company.
It's just a denominator effect.
So it isn't that Ethos is charging less for the exact same term life policy they sold last year?
No, the pricing power is still completely there.
It's just that out of the 107,000 policies sold, a larger percentage of them happen to be the smaller ticket whole life items.
Precisely. And to alleviate any concern that this mix shift was hurting the bottom line, the CFO provided the single most important data point regarding their unit economics.
Which was?
Every single policy activated on the Ethos platform is independently profitable. And more importantly, they are variable cash flow positive within 60 days of activation.
Cash flow positive in 60 days. I mean, that is the metric that justifies everything else.
Is the ultimate validator for a growth company. I mean, think about the customer acquisition cost that cascaded.
Right.
Let's say Ethos spends a certain amount of money on marketing, underwriting API calls, and administrative overhead to acquire a customer. When they issue that policy, they are initially in the red for that specific user.
Obviously, they spent money to get them.
But what the 60-day metric means is that the premiums collected minus the cost of the underlying insurance risk and the acquisition cost cross the break-even point into pure profit in less than 2 months.
That's incredibly fast. So once you hit day 61, that customer is just printing free cash flow for the business.
Exactly.
When your payback period is that tight, the concept of average revenue almost becomes secondary to just total volumetric scale.
It really does.
Like, if I have a machine that costs me 50 cents to run and it spits out $1 every 60 days, I don't care if a new version of the machine only spits out 90 cents, as long as it still only costs 50 cents to run and pays me back in 60 days. I just want to plug in as many of those machines as possible.
And that is exactly why their aggregate contribution profit, which is the absolute dollar amount of profit generated after variable costs are stripped out, was up 66% to $62.3 million this quarter.
They focused on absolute dollar generation.
Not maintaining an artificially high average revenue per user just for the sake of the metric at the expense of total volume.
This mechanism of acquiring customers, processing them instantly, and generating profit in 60 days, it feeds directly into the overarching strategy that CEO Peter Colis outlined.
The virtuous data cycle.
Yes, he referred to it as a virtuous data cycle. He made this very deliberate statement on the call: Ethos gets better as it gets bigger.
Which is a great line.
Because they are vertically integrated, meaning they own the marketing funnel, the digital application, the underwriting algorithm, and the policy issuance, every single piece of data stays in-house.
They aren't outsourcing the underwriting to some third party and losing that intelligence?
Exactly. So how does that data actually compound their advantage over time?
Well, it goes right back to the 1 million logic rules in their underwriting engine that we talked about. Machine learning models require vast amounts of structured data to improve.
So every time one of those 107,000 new families applies,
Ethos is collecting hundreds of data points on consumer behavior, API retrieval speeds, risk correlation, conversion rates, everything.
And the algorithm analyzes this new data to identify micro patterns.
Exactly. Maybe it learns that applicants in a specific zip code who have a minor prescription history for a certain drug actually have a lower mortality risk than previously thought.
So the system updates the rule on its own. It realizes it can safely approve that specific profile instantly, whereas a legacy carrier would still require a blood test.
Right. The refined risk model improves their unit economics. They can underwrite more accurately, price the policy more competitively, and approve more people instantly.
And because the unit economics improve, their profit margins widen.
And what do they do with that extra profit? They immediately deploy it back into the top of the funnel marketing.
Which explains another massive number from the call. They noted that they more than doubled their marketing spend year over year.
Now, in digital marketing, there is a widely accepted law of diminishing returns.
Oh, for sure. Usually when a company doubles its ad budget on platforms like Meta or Google, their customer acquisition cost just skyrockets.
You exhaust your most likely buyers really quickly.
And then the algorithm have to start showing your ads to less qualified, more expensive audiences just to spend the budget.
But Ethos stated that despite doubling their ad spend, their return on ad spend, their ROAS, didn't drop.
It actually showed sequential improvement.
And this is where the virtuous cycle closes the loop. Because Ethos has a proprietary real-time understanding of exactly how profitable a specific customer profile is within 60 days, they can feed that exact lifetime value and conversion data back into the digital ad platforms.
They are telling the ad algorithms exactly who to target.
With a level of precision that traditional insurers simply do not possess.
Because a legacy insurer doesn't even know if an ad campaign was truly profitable for 6 months because of the manual underwriting delay?
Exactly. Ethos knows almost instantly. They avoid the law of diminishing returns because their targeting is constantly sharpened by real-time underwriting data.
Okay, so we have established the mechanics of their historic quarter. We know the revenue numbers, we understand the 60-day cash flow dynamics, the mix shift, and the virtuous data cycle.
We've got the whole picture of Q2.
But capital markets are forward-looking mechanisms. An investor isn't buying the Q2 results. They're buying the discounted value of all future cash flows.
You're buying the future.
Exactly. They are buying what management believes the company will do in the back half of the year and beyond. So let's dig into the management guidance, because the signals they sent here are profound.
The guidance is really where you separate the companies that had a lucky quarter from the companies that are experiencing structural, sustained acceleration.
First up, they raised their full year 2026 revenue guidance. They are now projecting between $727 million and $731 million for the year.
And at the midpoint, that represents an 88% annual growth rate.
Which is huge. They also raised their adjusted EBITDA guidance to a range of $119 million to $123 million.
Let's look at the balance sheet supporting this too. They reported a cash and investment position of $252.9 million.
And critically, there is zero debt mentioned on the balance sheet.
None. The cash generation profile is exceptionally strong. They posted operating cash flow of $35.7 million for the quarter.
Now, to be rigorous, the CFO did specify that this included an $8 million timing benefit from a carrier partner settlement that hit this quarter instead of next.
Right. But even if you back out that $8 million, you are still looking at nearly $28 million in pure operating cash flow in a single quarter for a company growing at over 100%.
But the absolute loudest signal in the entire earnings call to move that really forces an investor to sit up and take notice is what the board authorized to do with that cash.
The buyback.
Yes. They announced a $100 million share repurchase program executed via a Rule 10b5-1 trading plan.
If we connect this to the bigger picture, this is a huge deal.
Let's break down exactly what this means, starting with the 10b5-1 plan itself, because it's a specific legal mechanism that indicates how management intends to execute this buyback.
Right. So a Rule 10b5-1 plan is a regulatory framework established by the SEC. It basically allows corporate insiders, or the corporation itself, to set up a predetermined automated schedule for buying or selling their own stock.
And the purpose is to establish an affirmative defense against insider trading accusations, right?
Sure. Exactly. Because management possesses material, non-public information, they know how daily sales are tracking before the public does.
So to avoid the SEC claiming they bought stock right before a big positive announcement,
they set up a blind trust with a broker. They give the broker a strict mathematical formula, like if the stock price dips to X, buy Y number of shares on these specific dates.
And once the plan is in place, management cannot alter it based on new inside information.
Right. It puts the buyback on autopilot.
But, the legal mechanism is really secondary to the financial implications of the decision itself. I mean, a hyper-growth, tech-enabled financial company scaling revenue at 113%, authorizing a $100 million stock buyback. It's almost a paradox.
It completely violates the standard tech playbook.
Usually a company in this phase of its life cycle is hoarding every single dollar of cash it can find.
Right. They need cash to hire specialized software engineers, expand into new international markets, build massive data centers.
Or just to have a war chest to survive a potential macroeconomic recession.
Or, conversely, they are actively diluting shareholders by issuing new stock through secondary offerings to raise more capital to fuel their cash burn.
Exactly. But Ethos is looking at their internal metrics. They see a 37% cash flow conversion rate. They see $252 million in the bank.
And they are making a highly calculated capital allocation decision.
They are essentially saying our core business generates so much organic cash and our unit economics are so tightly profitable that we don't need to hoard this money to survive.
In fact, when we look at our internal projections versus the current public market price of our stock, we believe the absolute highest return on investment we can get for our capital is simply buying our own shares.
It's like playing with house money at this point. It is the ultimate display of capital allocation confidence.
Management is explicitly signaling to the market that they believe the stock is undervalued relative to their internal forecasts.
And they are shrinking the float, which means every remaining share held by a retail investor represents a slightly larger percentage of ownership in the company's future earnings.
It feels like they're operating from a position of extreme leverage. I mean, they are generating cash so efficiently that they can buy back $100 million of their own stock while simultaneously funding massive long-term growth initiatives.
Right. Because, for example, they briefly mentioned they're building out a direct-to-consumer annuities platform.
Oh, yeah. Annuities are a massive multi-trillion-dollar legacy market that is just ripe for digital disruption.
And the CFO noted that this new product line won't even impact the 2026 financial results. They are funding a project that won't bear fruit for a year or two while still having enough cash left over to buy back stock.
But the most futuristic part of the forward-looking guidance, the segment of the call that really requires the deepest analysis for a long-term investor, was Peter Colis' commentary on agentic commerce.
Yeah, this was the moment in the transcript where we completely shifted from quarterly financial metrics into macro technological philosophy.
An analyst asked the CEO about the evolving landscape of artificial intelligence and large language models and how Ethos is positioning itself.
And the CEO stated that they view the shift toward agentic commerce as a material tailwind for the company.
We really need to dissect this because agentic commerce is the next logical evolution of digital retail.
And it fundamentally alters how consumers interact with the internet.
Right. To understand agentic commerce, we have to look at how we currently use the internet. Today, commerce is user-driven.
Okay.
If you want life insurance, you use a search engine. You type in best term life insurance. You get a list of blue links.
Right.
You click a link, navigate a website, read the terms, manually input your personal data into a form, compare the quote with another website, and eventually you click buy.
The human is the agent executing the transaction.
Exactly. The friction is entirely on the consumer. Even if the website is well designed, the user is still doing all the heavy lifting of research, data entry, and decision making.
So how does agentic commerce change that?
Agentic commerce removes the human from the execution phase entirely. An AI agent, powered by advanced large language models, acts autonomously on your behalf.
So in the near future, you will have a personal AI assistant that has access to your financial goals, your budget, and your basic medical history.
Right. And you will simply give it a directive. Like, I just had my first child. Find me a highly rated 20-year term life insurance policy for $1 million in coverage that fits my risk profile and secure it for under $50 a month.
And the AI agent just does it.
The AI agent then goes out into the digital ecosystem. It doesn't use a mouse or a keyboard. It communicates directly with corporate databases via APIs.
So it instantly queries a dozen insurance carriers, analyzes the actuarial tables, reads the fine print, negotiates the parameters, selects the optimal policy, fills out the application using your stored data, and executes the payment.
All that. And the transaction is completed in seconds without you ever even seeing a website interface.
That is the paradigm shift. And this is exactly why the CEO mentioned they are heavily investing in GEO.
Generative engine optimization.
Right. For the past 20 years, companies have obsessed over SEO, search engine optimization.
The goal of SEO is to structure your website so that Google's algorithm ranks you on the first page of search results for human eyes to see.
But GEO is entirely different. Generative engine optimization is the process of structuring your company's underlying data so that when an autonomous AI agent is scouring the internet to formulate an answer or execute a purchase, the AI identifies your company as the authoritative optimal choice.
You aren't trying to market to a human browsing Google anymore. You are mathematically proving to an AI model that your product is the most efficient solution for its user's prompt.
And this highlights the massive structural advantage Ethos has over legacy competitors.
Oh, completely. because an AI agent cannot interact with a system that isn't digitized.
Right. If an AI agent tries to buy a policy from a legacy carrier, and that carrier system requires a physical signature, a faxed attending physician statement, or a manual review by a human underwriter on an on-premise mainframe server,
The AI agent hits a wall. It literally cannot complete the autonomous loop.
so it will immediately abandon that carrier and move to a system that supports instant data transfer.
Which is exactly what Ethos is built for. They already have a 95% instant decisioning rate.
Their entire underwriting engine is built on API calls and 1 million logic rules.
They don't have legacy mainframes. They are cloud native and entirely vertically integrated.
They possess the exact digital plumbing required to seamlessly interface with autonomous AI agents.
A legacy carrier would have to spend billions of dollars and rip out decades of hard-coded IT infrastructure just to reach the starting line of agentic commerce.
But Ethos is already there, just waiting for the AI to arrive.
It is a profound strategic moat. They are scaling their current business with human consumers today, while simultaneously structuring their data architecture to be the default vendor in an AI-driven economy tomorrow.
We have covered a tremendous amount of ground today. We have the data from the quarter, we understand the story behind the mix shift and the 60-day cash flow metrics, and we've analyzed the forward guidance regarding buybacks and AI agentic commerce.
We really unpacked it all.
So, what does this all mean? Now it is time to synthesize this massive data dump into a definitive, actionable stance for you, the retail investor.
If you are looking at livestock, what does this actually mean for your portfolio?
The synthesis requires looking at the totality of the financial profile, not just a single metric. And my stance is unequivocally bullish.
I'd have to agree. Let's aggregate the case here.
You are looking at an enterprise that is accelerating its top-line growth to 113% year over year.
And usually that level of hypergrowth is a red flag for massive cash burn.
But Ethos is maintaining strict, disciplined profitability, generating almost $20 million in GAAP net income and $35 million in adjusted EBITDA.
Their proprietary underwriting engine has created a virtuous data cycle that allows them to double their marketing spend while simultaneously improving their return on ad spend.
They are bringing customers to break-even profitability in 60 days.
And they are generating such robust free cash flow that management is confidently returning $100 million to shareholders through a buyback program,
signaling their belief that the market is mispricing the asset. Finding a company in the tech-enabled financial sector that executes on both hypergrowth and GAAP profitability is exceptionally rare.
The quantitative financials justify the bullish stance, absolutely, but the qualitative market opportunity really provides the contextual weight.
Tell me about the total addressable market.
It's staggering. Peter Colis pointed out on the call that roughly 10 million Americans purchase individual life insurance policies every single year.
And despite Ethos's massive 113% growth rate, they are currently capturing only a single-digit percentage of that annual market.
The runway for expansion is massive. They don't need to invent a new market. They just need to continue taking market share from legacy incumbents who are fundamentally incapable of matching their digital speed and unit economics.
Exactly. However, an objective analysis requires acknowledging potential headwinds.
Always. For an investor, the primary metric to monitor over the next few quarters is the margin profile shift.
As we discussed, the third-party agent channel is growing exceptionally fast, up 90% this quarter.
And the unit economics in that third-party channel, while still highly profitable, are slightly skinnier than the direct-to-consumer channel.
Right, because you are sharing a portion of the economics with the external agent. If you acquire a customer directly through your own website, you keep the entire pie.
But if an independent broker brings you a customer, you have to pay that broker a commission, which compresses the margin on that specific policy.
So as the third-party channel continues to outpace the direct channel and becomes a larger percentage of total revenue,
the company's overall blended profit margin percentage might experience a slight downward compression.
But the CFO was very direct in addressing how management views that specific dynamic, right?
He was. He explicitly stated that they're not managing the business to artificially prop up a specific margin percentage rate.
They are managing the business to maximize absolute EBITDA dollars and absolute contribution profit.
Because for a management team, it is a deliberate choice. Would you rather have a 25% margin on $100 million in revenue or a 19% margin on $200 million in revenue.
The percentage is lower, but the absolute cash generated is significantly higher.
As long as every individual policy achieves profitability within 60 days, management will gladly accept a slightly lower blended margin percentage in exchange for massive volumetric growth.
Because absolute dollars matter more than percentages. You cannot pay your engineers or authorize stock buybacks with margin percentages. You pay for them with absolute cash flow.
Management's focus on absolute dollar generation is exactly the correct strategy for companies scaling at this velocity.
Well, that covers the fundamentals, the macro strategy, and the forward outlook for Ethos Technologies. But before we wrap up this deep dive, there is one final provocative thought that emerges from this transcript, a paradox that long-term investors really need to deeply consider.
The contradiction between their current growth engine and their future technological vision.
Exactly. We just spent a significant amount of time analyzing how Ethos is preparing for agentic commerce.
Right. They are investing heavily in generative engine optimization so that autonomous AI agents can instantly research, compare, and purchase life insurance on behalf of consumers.
Entirely removing the human from the transaction.
But we also spent a lot of time analyzing how their third-party channel, which is comprised of human insurance agents selling policies, is absolutely on fire.
Growing 90% year over year and driving a massive portion of their overall volume.
So here is the tension.
Right. If Ethos is successful in building the digital infrastructure for agentic commerce, and AI eventually becomes sophisticated enough to perfectly execute the role of an insurance broker, finding the best policy, instantly underwriting it via APIs, and securing the coverage without any human friction, what happens to the human agents?
It is the ultimate manifestation of the innovator's dilemma, right within their own ecosystem.
Given that Ethos's technological dominance is paving the way for automated purchasing, will their own advanced AI infrastructure eventually cannibalize the human agent network they are currently recruiting with such success?
Are they actively funding and building the very technology that will render their fastest growing sales channel obsolete?
It is a fascinating dynamic. They need the human agents today to drive volume and data, but the data they are collecting is training the very systems that might replace those agents tomorrow.
It raises profound questions about the future of distribution across all financial services. Navigating that transition from a human brokered marketplace to an AI agented marketplace without destroying their current revenue streams, that will be the defining management challenge of the next decade.
And that tension is exactly what you should be watching as this company evolves. As always, use this deep dive as a foundation. Go read the Q2 transcript for yourself, verify the metrics, understand the mechanics of the products, and do your own rigorous research before allocating capital in your portfolio. Thank you for joining us for this Talk Tickers deep dive. Keep digging, and we will see you next time.